Have you ever thought about what it really means when a business leases something? Maybe their office space or like a whole fleet of vehicles, even some really specialized machinery.
Yeah, on the surface, it seems simple enough, right? You pay a fee to use something you don't own.
Exactly. But what if the actual accounting definition of a lease is, well, way more complicated than you'd think, and it fundamentally changes how companies actually look on paper?
Oh, it absolutely does. And that's precisely what we're getting into today. We're doing a deep dive into IFRS 16. That's the big international accounting standard for leases.
Right.
And this standard, it wasn't just a small tweak. It completely changed the game for how companies account for leases. It sent pretty big ripples across their balance sheets, their profits, the lot.
Okay, so our mission for this deep dive is basically to unpack IFRS 16. We need to figure out, what exactly makes a contract a lease under these rules.
The precise criteria.
Yeah, and then how do companies actually record these things now? The mechanics of it on the financial statements, and maybe most importantly, what does all this mean for how we understand a company's financial health?
We've pulled together a good stack of sources to help us navigate this. Lots of key details in
And
it.
hopefully you'll have some real aha moments listening in, because honestly, by the end of this, you should have a much clearer picture of a really crucial bit of modern business finance, without getting totally bogged down.
Absolutely. A shortcut to getting informed.
Okay, let's unpack this then. So, starting point. For a contract to be a lease under IFRS 16, it needs to give the right to control the use of an identified asset for a set period.
Yes, the core definition.
My first thought on identified asset is just, well, it's named in the contract, right? But I have a feeling it's probably a bit more nuanced than that.
You're right. It is. Yeah, it's more than just being named. I mean, usually it is specified. But the really crucial part for it to be truly identified is that the supplier, the company providing the asset, can't have a substantive right to substitute that asset for another one during the lease term.
Okay, substitute.
So like if a truck breaks down and needs a repair and the supplier swaps it out temporarily, that's usually okay. But if they can just decide to swap at any time, maybe because it's more convenient for them, then it's generally not seen as an identified asset from the perspective of the company using it.
Okay. That makes sense. So it's about their actual practical ability to swap it, not just, having a clause somewhere. Do you have a quick example, maybe?
Sure. Think about, say, a local government. They contract with a waste company for 20 specific trucks to collect rubbish for, let's say, 6 years.
Okay.
The trucks are explicitly listed in the contract. The government decides the routes where the trucks are kept overnight, maybe even uses them for, other things occasionally.
Yeah.
And the provider can only swap a truck if it genuinely needs fixing. In that situation, those trucks are identified assets. The government really has the right to use them and direct how they're used for its own benefit. That contract definitely contains a lease.
Got it. That's a really clear distinction. So that handles the identified asset part and touches on getting the economic benefits. What about the second bit of control, the right to direct the use of the asset? What's the tricky part there?
Well, the trickiest part, I think, is figuring out if the customer, the lessee, really gets to decide how and for what purpose the asset is used throughout the whole lease period. If those decisions are kind of already baked in, maybe by how the asset is designed or spelled out really rigidly in the contract, then you look at other things like, does the customer have the right to operate it without the supplier changing those instructions? Or maybe did the customer actually design the asset in a way that predetermines its use?
Okay. Can you give us an example where it feels like the customer has control, but under IFRS 16, they actually don't have that right to direct use? Because I imagine that's a common mistake.
Oh, absolutely. It's a classic area for confusion. Imagine a company, let's call them customer C. They hire a trucking company, Haulier H, to move specific goods from London to Edinburgh.
Okay.
The contract specifies a particular truck, so it's identified, and Haulier H can't just substitute it. Customer C's goods fill the whole truck. The contract locks in the goods, the pickup date, the delivery date. Crucially, Haulier H operates the truck, maintains it, and is responsible for getting the goods there safely. Customer C can't hire anyone else for that truck or drive it themselves.
Okay, so identified asset. Check. Economic benefits. Yeah, C gets all the truck's capacity for that trip. But directing use. My gut says if I'm choosing the goods and the destination, I'm directing it.
See, that's where the nuance bites. In this case, the standard says this contract does not contain a lease. Yeah. Even though there's an identified asset and C gets the economic benefits, C doesn't direct the use in the way IFRS 16 means it. The how and for what purpose, moving specific stuff between London and Edinburgh on set dates, that's all predetermined by the contract. C has no decision-making rights about how that truck is used beyond what was already agreed. So C is essentially just buying transportation services. It's service contract, not a lease of the truck itself.
Wow, okay, that's a super sharp distinction, but it really clarifies what directing use means here. It's not just specifying the outcome, but controlling the how during the period.
Exactly.
So, okay, we've nailed down the definition. Now, the next big thing, and maybe the part that really shook up financial statements everywhere, how does IFRS 16 actually make companies record these leases?
Right.
Because that's where the real impact hits the numbers, right?
That's absolutely right. For the lessee, the company using the asset, the rule now is, with only a couple exceptions we'll touch on, they have to recognize two things on their balance sheet right at the start of the lease.
Okay, what are they?
First, a right of use asset. This basically represents their right to use the item they're leasing. And second, a corresponding lease liability, which is their obligation to make the lease payments.
And this was the massive change, bringing leases onto the balance sheet.
Monumental shift. Before IFRS 16, many leases, especially operating leases, were kept off balance sheet. Now suddenly companies had to add potentially huge assets and liabilities to their books.
Right. So this isn't just some, minor accounting adjustment. It means companies that maybe looked asset light before suddenly showed significant debt obligations they never had to report in the same way. That's a total game changer for investors, for analysts trying to compare firms.
And definitely a game changer.
So how is that initial lease liability actually calculated? Is it just like adding up all the payments they're going to make?
Not quite that simple. It's measured initially at the present value of the lease payments that haven't yet been paid when the lease starts.
Present value.
Yeah.
Okay, discounting.
Exactly. You take all those future payments and you discount them back to what they're worth today. That reflects the time value of money. $1 today is worth more than $1 in 10 years. And you use the interest rate that's implicit in the lease itself, if you can figure that out.
Okay. And what about the other side, the right of use asset? How do you figure out its initial value?
So the starting point for the right of use asset is that initial lease liability figure we just calculated.
Right.
Then you add any lease payments made before the lease actually started, minus any lease incentives the company received from the lessor. You also add any initial direct costs the lessee incurred, like commissions or legal fees to set up the lease. And finally, you might even add an estimate for future costs of dismantling the asset or restoring the site if there's an obligation to do that.
Wow, okay, so it scoops up all those initial costs needed to actually get the asset ready and usable. And then I assume, like other assets, it gets depreciated over time.
Yes, exactly. The right of use asset is then depreciated, usually on a straight line basis, over the shorter of the asset's useful life and the lease term.
Shorter of the two.
Yeah. The only main exception is if the lease includes transferring ownership of the asset to the lessee at the end. If that happens, then you depreciate it over the asset's full useful life, just like if you'd bought it outright.
Okay. And the lease liability, what happens to that number on the balance sheet over the lease term?
The lease liability behaves a lot like a loan repayment. It's measured using what's called amortized cost, using that same interest rate. So each period, interest accrues on the outstanding liability balance, making it go up slightly.
Interest expense.
Right. That interest component hits the profit or loss statement as an expense. Then, when the lessee makes their regular lease payment, that payment reduces the liability balance. So over time, the liability gradually reduces down to zero by the end of the lease, just like paying off a mortgage or a loan.
This sounds pretty involved. Lots of calculations. Can we maybe walk through a simple scenario just to see the numbers conceptually?
Yeah, absolutely. Let's take a common one. A 20-year lease for one floor of an office building.
Okay.
Say the annual payments are $80,000 paid at the end of each year. And let's say the lessee also paid $25,000 in initial direct costs, like legal fees. The interest rate implicit in this lease is 6% per year.
Okay, so 20 years, $80K a year payment, 6% interest, $25K upfront costs. What does that actually put on the balance sheet on day one?
Right, so first the liability. You take those $80,000 annual payments for 20 years and discount them back to today using that 6% rate. That calculation gives you an initial lease liability of just under $918,000. That's a debt that goes on a balance sheet.
Nearly $1 million.
Yeah. Then the right of use asset starts with that $918,000 liability amount, and you add the $25,000 in initial direct costs. So the asset goes on the books at about $943,000.
So boom, A new asset of nearly $950K and a new liability of over $900K appear where maybe nothing was before.
Precisely. A big impact on the balance sheet totals.
And how would that liability change in, say, the first year?
Okay, so over year one, interest would accrue on that initial $918,000 liability at 6%. That's roughly $55,000 of interest expense.
Right.
Then at the end of the year, the company makes its $80,000 payment. So liability increased by $55K interest, then decreased by the $80K payment. The net result is the liability reduces by $25,000.
Yeah.
$80K, $55K. So by the end of year one, the liability would be down to about $893,000.
And that process just continues year after year. Interest accrues, payment reduces principal.
Exactly. Until it's fully paid off after 20 years.
And thinking about financial reporting, how do companies split that liability between like current and non-current on the balance sheet?
Yeah, good question. It's based on timing. The current portion of the lease liability is essentially the principal reduction that's expected to happen within the next 12 months. So at the end of year one, in our example, you'd look at the total liability, $893K. Then you'd figure out how much principal will be paid down by the payment due at the end of year two. That amount is your current liability. The rest is non-current.
Got it. So the split changes each year as more becomes due within 12 months. Given all this complexity, are there any situations where companies get a bit of a break? Any simpler options allowed?
Yes, thankfully there are. IFRS 16 includes two key practical expedients or exemptions that lessees can choose to apply. One is for short-term leases.
Short term. How short is short term?
Generally, it means a lease with a term of 12 months or less at the commencement date. And importantly, it must not contain an option for the lessee to purchase the asset.
Okay.
If a lease qualifies, the lessee can elect not to do the whole right-of-use asset and liability accounting. Instead, they can just recognize the lease payments as an expense, usually straight line, over the lease term. Much simpler.
Right, like the old operating lease treatment?
Pretty much, yeah. But it's an election they have to make consistently for similar types of assets.
Okay, so if a company leases, I don't know, all its laptops on rolling 12-month contracts, it could potentially just expense those payments. What's the second exemption?
The second one is for leases of low-value assets.
Low value. Is there like a dollar threshold?
The standard doesn't give a specific number, which can be a bit tricky. Instead, it gives criteria. It's assessed on an absolute basis, so it doesn't matter if the lessee is a huge multinational or a tiny startup. A tablet is potentially low value for anyone.
Okay, so what makes something low value then?
Key criteria are: the lessee can benefit from using the asset either on its own or with other resources that are readily available to them. And the asset isn't highly dependent on or highly interrelated with other assets. Crucially, though, an asset can only qualify if it's the type of asset that is typically low value when new. So leases of cars, for example, would almost never qualify, even if the lease payments are small. But things like tablets, personal computers, maybe small office furniture, those often do qualify.
Right, that makes sense. It prevents people from, say, leasing a small part of a very expensive machine and calling it low value.
Exactly. It's about the underlying asset itself. And again, it's an election applied lease by lease.
Okay, that helps clarify where companies can use a simpler approach. So moving from simplifying things for small items, let's talk about something that sounds potentially much more complex and often strategically driven. What happens when a company sells an asset it owns, but then immediately leases it back? Sale and lease back.
Ah, yes, sale and lease back transactions. These are quite common. A company sells an asset, maybe a building or some equipment, gets cash up front, but then immediately signs a lease to continue using that same asset.
Right, so they free up capital but keep using the asset. How does IFRS 16 handle the accounting for that?
The critical first step is to determine if the initial sale part of the transaction actually qualifies as a sale according to the rules in IFRS 15, which is the standard for revenue recognition.
Okay, so it depends if it's a real sale first.
Exactly. Did the seller, who is now becoming the lessee, effectively transfer control of the asset to the buyer, who is now the lessor? That's the key question under IFRS 15.
So assuming it is a proper sale, according to IFRS 15, what happens then? Does the company just book a big profit on the sale, or does IFRS 16 try to look through the transaction more carefully?
It definitely tries to look through it. If it qualifies as a sale, the seller lessee does two main things. First, they recognize a right-of-use asset relating to the leaseback. But the value of this asset isn't based on the lease payments. It's based on the proportion of the asset's previous carrying amount, what it was worth on their books before the sale, that relates to the right of use they've retained through the lease.
Okay, that sounds complicated already.
It is a bit. And here's the really interesting part regarding profit. The seller lessee only recognizes the amount of any gain or loss on the sale that relates to the rights that were actually transferred to the buyer lessor.
Only part of the gain.
Yes. The portion of the gain related to the rights they effectively kept by leasing it back isn't recognized immediately. Meanwhile, the buyer lessor just accounts for buying the asset and then leasing it out under the lessor accounting rules.
Okay, I need an example for this gain recognition part because recognizing only some of the gain on something you just sold feels, well, counterintuitive.
It does, but it reflects the economic substance. Let's say Company X sells a building to Company Y for $4.5 million cash. That $4.5 million is the building's fair value.
Okay.
Just before the sale, the building was on Company X's books at a carrying amount of $3.5 million. So on paper, there's a $1 million gain, 4.5 meter sale price, 3.5 meter book value.
Right, $1 million gain.
Simultaneously, Company X leases the building back from Y for 20 years. Let's assume this transaction does meet the IFRS 15 criteria to be treated as a genuine sale.
So X sells, gets the cash, leases it back. How much of that $1 million gain do they actually book straight away?
Right, here's the key. X does not recognize the full $1 million gain immediately. Because X has retained the right to use that building for the next 20 years via the leaseback, only the part of the gain that relates to the rights truly transferred to Y, like the residual value at the end of the lease, the ownership rights what now holds, gets recognized.
And how much would that be, roughly?
Well, the calculation involves comparing the present value of the lease payments to the fair value of the asset. But in a typical scenario like this, maybe only around, say, $446,000 of that $1 million gain would be recognized immediately by Company X.
Wow. So the rest of it, more than $500,000, is effectively deferred because it relates to the use X still has.
Exactly. It's tied to the right of use assets they recognize for the leaseback. It reflects the fact that X didn't completely dispose of all its rights related to the building.
That is very specific. It really shows how IFRS 16 tries to capture the underlying economics. Okay, what if the flip side happens? What if that initial transfer doesn't qualify as a sale under IFRS 15, even if legally the title changed hands?
Good question. If it fails the IFRS 15 sale test, then for accounting purposes, it's treated as if the seller never actually transferred the asset.
So the building stays on Company X's books?
Yes. The seller, Company X, just keeps recognizing the asset as before with no adjustment, and the cash proceeds they receive from the buyer, Company Y. That $4.5 million is treated simply as a financial liability, basically, a loan secured against the asset. It's accounted for under IFRS 9, the standard for financial instruments.
So it's not a sale and leaseback at all in substance. It's just a financing deal.
Pretty much. It's viewed as a secured borrowing arrangement, not a sale.
Okay, so let's try and pull this all together. We've covered quite a bit of ground on IFRS 16.
We certainly have. I think the big takeaway is that under IFRS 16, a contract only counts as a lease if it gives the right to control the use of an identified asset for a period. And remember, control means having rights to the economic benefits and the power to direct the use.
Yeah, and that definition leads to that huge shift in accounting. Most leases now have to go on the balance sheet. You get this right of use asset and this lease liability, and they're, complex calculations for setting them up and accounting for them over time with interest and depreciation.
That's right. Although, don't forget those exemptions for short-term leases and low-value assets, which do offer a simpler path in some cases.
True, the practical reliefs. But then you have the more complex stuff like sale and leaseback deals, where you might only recognize part of a gain immediately, really reflecting the rights you've kept versus the rights you've transferred.
And understanding all this is really key, isn't it? Because IFRS 16 fundamentally changes how a company's financial position and even performance are presented. If you're comparing companies or just trying to understand their debt levels, you absolutely need to grasp these accounting treatments.
Definitely. It especially hits those financial ratios we all look at, like return on capital employed or gearing ratios measuring debt. Companies might look more leveraged now or perhaps less efficient with their capital purely because of this accounting change.
Exactly. It requires a deeper level of analysis.
So maybe a final thought to leave people with. In this world where financial reporting is always striving for more transparency, how do you think a detailed standard like IFRS 16, which brings so much onto the balance sheet, both clarifies and maybe complicates our view of a company's real operational and financial strategy? Does it make you always need to dig deeper than just the surface numbers?